In this video, we're going to explore a curiosity about retail trading, since in the last video I talked about how much money market makers or large traders can make with their manipulation maneuvers. I thought it would be an interesting idea to explore the limits of the retail trading industry according to the current standards and limits provided by the most reliable brokers on the planet. When we talk about retail trading, I believe that the best market to trade is the foreign exchange market due to its liquidity and leverage. Liquidity is good because it means larger orders can be executed quickly, and leverage means we can gauge risk with more flexibility. Leverage is a tool to be used wisely. It's not a tool to make you rich faster despite what most people believe. Okay, so I did some research with the most technologically powerful foreign exchange brokers on the planet, and most of them have the same limits for the retail trader access to the markets. The largest order you can usually place in the foreign exchange market is 100 lots, which represents 10 million units of whatever currency you're trading. 100 standard lots also give you about $1,000 of profit or loss per pip of market movement, which is insane if you think about it. The even more interesting thing is that most reliable brokers will allow you to have a maximum of 200 orders open simultaneously on the trading terminal. That represents a limit of 200 orders of 100 lots each in a retail trading terminal. That will be a total of 20,000 standard lots and about $200,000 of profit or loss per pip of movement in the market. You may be thinking that it's impossible to open 200 orders at the same time, and you are correct. But in the foreign exchange market, due to its massive liquidity, these orders can be opened fairly quickly. If you trade in higher time frames, like the 30-minute and above, for example, that wouldn't necessarily be a problem if you have an algorithm to trigger the orders for you. Okay, so let's make some calculation of what these numbers could mean for a trader with a very modest but consistent performance in terms of pips. Let's say that a trader has an average of 5 pips of profit per day, which sums to 100 pips of profit per month. On a day-to-day basis, 5 pips a day might seem like nothing is happening, but at the end of the month it will add up. That's why consistency is way more important than peak performance. 5 pips on a daily and consistent basis is much more powerful than the occasional day with 50 pips of profit. That's a bit counterintuitive to most people, but if you do the math, you realize it's true. We already established that the maximum order you can open is 100 lots, and you can have a total of 200 of those orders in a retail trading terminal. Let's say that a trader reaches a point where he can open 5 of these 100 lot orders, and he maintains a performance of 100 pips per month. 100 pips per month at $5,000 per pip will give you $500,000 in a month. That's assuming a modest performance and only 2.5% of the order limit of the retail trading industry. Obviously, reaching levels like that is insanely difficult, and that won't happen to the vast majority of traders because of the many challenges of the business. I'm only exploring a little bit what the true limits of the retail trading world are. It's interesting to note that the retail trading part of the business gives you the ability to become a market maker if you are really driven and if you have the knowledge and capital to do that eventually. That's because the 200 orders of 100 lots gives the large retail trader the capacity to purchase $2 billion, which is enough to move any market. If you remember that last video about how much money market makers can profit, you remember that 1 pip in the euro dollar has about $100 to $200 million of depth. So theoretically speaking, a very large retail trader can manipulate the euro dollar by 10 to 20 pips. This amount of pips is certainly enough to trigger some types of manipulations where price bounces off a normal barrier recognized by most of the market. The large retail trader aspiring to be a market whale would unload the positions carefully along the way, but there is no question that a lot of the market would follow that manipulation. That's if we're talking about the euro dollar, which is a giant market. If you take a less liquid market, the amount of pips that a large retail trader could move would obviously increase. It's interesting to know that there is such a thing as a large retail trader and a small market maker. And there is no actual barrier that can stop a very driven retail trader to become a market maker by climbing the inherent supply and demand mechanism of the market. There are stories of small market makers that assumed the control of weak currencies around the world, and the respective government had to intervene to stop such individuals to whip the currency around at their will. I believe this has happened with the old German mark and the Romanian currency near the 1990s. In future videos, I will try to illustrate the types of manipulations that a small market maker could make to bridge between large retail trader to solid market maker. I hope you found this video interesting. If you wish to learn more about professional trading, please check my trading courses in the video description. Don't forget to support the channel by clicking the like button, subscribing to the channel, and leaving your comment below. Thanks for watching. Take care.